Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. I'm bringing you part 4 of a 4-part series I did on It's a Market of Stocks, Not a Stock Market, assessing the risks of valuation or overvaluation. You know, not all the stocks that I've covered here are the same, but yet almost all the stocks that I covered send out the same message. Once you are in an overvalued stock, it becomes extremely risky to hold. It becomes very difficult to make money. And even though the stock can run and keep going up for even years, let alone months, at the end of the day, you can end up giving up almost a decade of opportunity because you didn't pay attention to the amount of risk you were taking. So we're going to cover the last 29 stocks in the group of 131 that I covered in this 4-part series. Links to the other 3 parts are also being at the bottom of this video. So let's get into FastGraphs and look at the last 29 of 131 stocks that I basically went through the S&P 500 and came up with some really good lessons in valuation. The first one we're going to start is one that's been requested several times by people, and that's Supermicro Computer. And what you see here in the historical chart, and I'm going to leave the summary, go to the historical chart, you can see that this was a stock that had pretty good growth over the years, 15%, but then also periods where it didn't grow very much and the stock price didn't do very much. All right, there is a very strong correlation, as you see here, between what the operating results, which is the orange line on the graph, or the growth of the business, and how the stock price itself performs. And then as we saw earnings surge, we start seeing the stock price surge, but eventually that got carried to an extreme. Okay, and this extreme overvaluation led to a point where there were some real issues, short selling, delays in expressing financial statements, and we had this, just this huge, and I'm not hitting tops and bottoms here, just in the range. We had this, over 70%, 75% drop in the price, and then since that time, we've had a lot of volatility. But as I shorten the time frame, you can see that we still have a lot of growth here. As far as going forward, the company is expected to grow at 38% a year, and that's even after analysts have reduced their estimates, as you can see here. They're still expecting a lot of growth. This is a leader in AI. It has major contracts with NVIDIA, and right now you can buy the stock relative to its growth at a very reasonable valuation of 19 times earnings. Now, when you're dealing with any stock that's growing over 15%, the PE equals growth rate formula that Peter Lynch made so famous, a lot of people call it the PEG ratio, comes into play. So we're looking at a 38 multiple here. The company's normal multiple over this market has been about 13 over the last 4 or 5 years. But even that low multiple would still give you an opportunity to make 17% a year. So Supermicro is an interesting one that you can follow or invest in or watch as a growth stock participating in the AI movement. Now here's Snap Inc. It's an interactive media services company, and I'm not real familiar with this stock, so I went to the company's corporate website, and you can then see, what the company does and what some of their products are and learn about it. But the thing that I found striking is this is a stock that the market got enamored with coming out of COVID. Okay, the stock rallied. I mean, just look from bottom to almost the top here. The stock rose something like 560% in just 2 years. But this was a crazy valuation. The fact that the price-earnings ratio was unmeasurable because there weren't any earnings. I want you to notice that. They were losing money. And then, since that time, or roughly since that time, now the stock has fallen 88%. And for the last 3 years, it's done virtually nothing, as far as being a long-term owner of the stock. And here's a case where it wasn't just so much valuation, there wasn't even any profit. But yet people thought apparently that this stock was going to be a real profitable stock. Now, a lot of times when you're looking at companies like this that are relatively new and don't have a long track record, sometimes you want to look to sell. So we did have very strong sales growth. Didn't bring any to the bottom line really for all these years, but we still see the massive overvaluation that occurred in the stock. The next stock on our list is Synopsys, and this is one that's a little more subtle that I wanted to point out. See, once valuations got high, first of all, the market's always put a pretty high valuation on the stock. But once valuations got high, it became very difficult to make money because of the volatility. And up here, when we start getting into real high valuations, we go a year and a half or so where there's literally no return in the stock over, buy and hold investment, but a lot of volatility. And you got to ask yourself, as an investor, can you endure these kinds of rises and drops in stock price over such short periods of times? So Synopsys gives us a good lesson in the risks of investing in overvalued stocks. Sempra here is one that just got highly valued, not a very fast-growing company, but it's average growing. But here we see periods. First of all, we come into COVID, we see a very high valuation. We hold it all these years and we make 2% a year, even though the company might have done a little better than that, but not much. But the point is, when you're buying these stocks at overvalued levels, you don't make any money. Now, if you do buy it when it's trading on the orange line, which is theoretical fair value, you can turn a 2% return into double-digit returns. But you're still doing it facing a lot of risk and an awful lot of volatility. Here's Steris, another example. The valuations got ridiculously high, and then we go through this period where there's literally negative rates of return over a several-year period, simply because you were paying too much for a stock that wasn't worth what the market was valuing it at. I call it the definition of appreciation is when the market appreciates something more than I do, and this is a classic example of that. The next one is Constellation Brands, and we'll go ahead and max this out. And you can see that it was tracking earnings or even being undervalued coming out of the recession of 08 and 09. And then we did see a surge in earnings growth during this period here, where we had some really strong years of earnings, and the stock was sort of being priced accordingly. But once it kind of started to falter and earnings flattened out a little bit, we get again in this period where we go through several years where you actually lose money owning the stock and you face all this volatility. And this is what I'm trying to make clear here. When you're dealing in high-valued stocks, for whatever the reasons are, you're taking a lot of risk and you're usually going to face a lot of volatility, and it's going to be very difficult to make any money. Now, Stanley Black & Decker is an interesting case where we had high valuations, and that made it difficult to make money, but then that was basically exasperated by the fact that the earnings collapsed. But here's where you would look into something like Fiscal Fitness and go and look at things like margins, and you would discover by looking at their net margin number that net margins literally collapsed, so you'd have had some warning. And you could look at things like returns on assets, and again, see the same thing, returns on equity, and see the same thing, that there was no returns on equity during these periods of time. So you would have had ample warning that there was a problem that the company was facing starting as early as 2021 or so. The next stock on the list is Sysco, the food distributor. Again, the market likes to put a high valuation. The stock has had kind of a lumpy record coming through COVID with all the restaurant closures. They really had some, really horrible earnings years, a couple of bad years where they actually, earnings fell by 43% and 28%. The stock went through the flash crash, but then earnings began to recover. The stock recovered with it, but then when they began to slow down growth again into the single-digit level, you can see that the stock just goes sideways. Valuation matters. It matters a lot. I don't get tired of saying that, but I want to point out that you're taking an enormous amount of risk when you're investing in overvalued stocks, even though the market will let it go on for years. And Teledyne Technologies is a great example. It tracked earnings, but then we got this irrational, exuberant period, and the stock did real well for 3 or 4 years, and then it gets up here to a pretty high level, and then all of a sudden the rates of return, begin to falter, and then when it got really high, let me get into the really high valuations. Then we saw periods where you would go a long period of time making 2 or 3%. And this takes a lot of patience to own a stock. And again, note the amount of volatility you face when that begins to happen. Techne is another classic example of almost the same story, but here it's a little more demonstrative. You see this, massive rise in valuation with, coming out of COVID, and we did have one really great year, and this is a June fiscal year, where the stock got really crazy. But, anywhere you bought it in here, you've been losing money holding the bag and losing a relatively lot of money. But even if you bought it back here where it was overvalued and held it to now, you're still losing money over this 5 or 6 years, despite all of this, volatility and craziness that the market applies. Don't think for a moment that the stock market doesn't from time to time misappraise stocks, either over or under. Same with TE Connectivity here, electronic manufacturing. We get, these crazy high valuations, and then we get periods where you go a pretty long period of time making virtually no money. And by the way, almost any money you made really came more from the dividends than anything else. You got $545, almost $6 in dividends versus only $488 in capital appreciation. But, it wasn't very long ago that you'd have also, shown almost no growth or actually negative growth on your money. High valuations are risky and they're dangerous. And all these stocks have their own unique, ways of doing that, but yet it's always the same. Valuations get high, stocks go sideways to down, and you could end up losing years of return on your money because you simply paid too much for a stock. And here, once again, you could go into fiscal fitness and start looking for things like margins and seeing whether or not, the margins were beginning to falter and give you a clue that the company may be, facing some problems. Now, you could also follow analyst estimates, et cetera. But the point is, there were clues here. You could have got out in here somewhere before all this carnage and all this volatility happened. But you're never going to time it perfectly, and don't be naive enough to think you can. I did a full video on Target. Target had this huge surge. And, I was asked in the comment section on this video what, caused that, what had to do with changes in consumer spending habits. It had to do with the fact that their online business really exploded, but yet their store traffic kind of did well as well coming out of COVID. Remember, some of these big box stores were the only ones that were allowed to be open. A lot of the little guys, unfortunately, were forced to close. But once again, when you pay really high valuations with no earnings yield, you can go to periods where you have years of losing money on the stock. And the biggest culprit here is the fact that the stock was so massively overvalued. Then here's Thermo Fisher Scientific. Once again, this is going on for years where the stock was trading at very high valuations. Now, the market had a penchant for doing that with this company anyway. It's an A-rated company with very little debt. But then even when you see, these periods of high valuation, then you go to these periods of extreme. And once you get to the extreme, you face, the exposure, you're taking the risk of seeing 3.5 years or more, or even if you go way back here and look at it from a standpoint of, even though that stock rallied after that period of time, you went, 4 years here, over 4 years where you had negative rates of return, only because valuation. The company did have some earnings issues, but they were still very highly profitable. Remember, this was, probably the second highest earnings year they ever had. This was the third highest. And, this is probably the fourth and fifth highest. So it wasn't like the company was bleeding red ink. They just had a slowdown in earnings, and the stock was exposed because it was highly overvalued. We see the effects of high valuation with Trimble. Look how it reverts to the mean. Just a flattening of earnings that caused that. Once again, high valuation, high risk, no real return over periods of years once you get to that point where the valuations get completely unattainable. And of course, Tesla is a classic example. Tesla, really wasn't doing so much when they weren't making any money, but then they started to make a little money and the market got hot and everybody was in love with Tesla. Of course, now everybody hates Tesla. But the bottom line is you see here when you get high valuation, an awful lot of volatility, but there's no real traction on the stock. Tesla would be, a much better investment if it was trading in the, $60, $70, $80 a share. Because even looking at it going forward, we're looking at 20% growth, but we're paying a high valuation, over 150 times earnings, with less than a 1% earnings yield to be able to participate in that growth. And to me, that doesn't make any sense. And if we go now to Texas Instruments and look again, same story. Look how many times this pattern's basically been repeated in different companies. We get a period of irrational exuberance, then we hit kind of a high mark of valuation, and then we get to this period where you get nothing going on the stock, or you get no returns at all because it was simply the risk of high valuation. And obviously, it takes just a little bit of weakness in earnings to really cause that. UnitedHealth, we all know the story. They're being investigated. Of course, here was a stock that was highly valued, and it stayed highly valued for 3 or 4 years here, 5 or 6 if you really want to look at it. You could even go back to here and say 7 or 8, but then now we've had this collapse. High valuation is risky. You should, protect yourself. And this is what I call the obvious mistake. And investors, in my opinion, should not make the obvious mistake paying too much. We saw the same here with Union Pacific, a railroad. We just, get these high valuations. Even though the business is doing okay, you don't really make any money. United Parcel was a good example of high valuation. And then it did run into a couple of years, 2.5, 3 years here, 3 years total of negative earnings growth. And once again, we could go into something like fiscal fitness and see that we were starting to see margin pressures, or you could look at returns on equity and see the fact that returns on equity have been dropping for several years. Returns on assets have been dropping for several years. So, there's clues that you can follow if you're really keeping up and doing the necessary research and due diligence to owning stocks. But my big message here with all 4 of these videos has been, when you see high valuation, and nobody expresses it better than Fast Graphs, beware, because you're taking a lot of risk to own the stocks, and there's a lot of places you can go where valuations are good, where you take a lot less risk, make a lot more money with a lot more safety than investing in these highly valued stocks. Waters, was a life sciences and tool services company, a premium valued business most of the time, but then when the valuation got crazy, negative rates of return coming for your stock. We just see it, the same pattern over and over. Of course, you get a situation like Walgreens where you see deteriorating fundamentals. Those should be real, issues that you should pay attention to. And you can see returns on assets turn negative here. We can see margins turn negative here. And of course, it was the demise of a once great business, has really been destroyed because fundamentals faltered, and they faltered very badly. But also the stock prior to that was extremely highly valued by the market. And that was just a place where you were entering a level of risk here that I think prudent investors shouldn't be taking. And here's a utility stock, multi-utility. And, you've got to really be careful. I mean, it's a pretty fast growing one as utilities go. But once you got up into this 25 multiple area, you didn't really make any money holding the stock for a long period of time. You got some decent dividend income, but you actually lost a little bit of your principal from the period I've measured here. Too much volatility, too much risk, and too difficult for people to say. And then Williams-Sonoma, don't know why it got so highly overvalued here, but you can see that the valuation came back into alignment almost immediately. You look at West Pharmaceutical, massively high valuations, nothing going on with the stock for years following that. You got Zimmer, a biotech, it gets crazy valued here. The company doesn't do that badly, but the stock does because, people that were buying it up in these levels were paying way too much to invest in the company at the time. So valuation matters, and it matters a lot. Zebra Technologies, classic, we have this surge in earnings growth. That gets everybody excited, but then earnings come back to reality, and now all of a sudden, anyone who's buying the stock up here at these crazy valuations, and by the way, you can buy it up here or down here, and the results are going to be similar, meaning that they're going to be negative. They're not going to be as negative or more negative, depending on where you actually, made the purchase. But valuation matters, and it matters a lot. And here's Zoetis, gets highly valued, overvalued, and you go through years of not making any money on the stocks at all. So anyway, this has been Chuck Carnevale, co-founder of Fast Graphs. I hope you enjoyed this 4-part series on valuation. It's a market of stocks, not a stock market. And I hope you recognize or starting to get clear in your head that even though all stocks are different, that make up the market, there are certain things that are going to be recognizable. I call it don't make the obvious mistake. When you see real high valuations on a stock, no matter how good it is, whether it's a Nike or a Starbucks like we looked at, or whether it's Target or any of these big names or any of these smaller names we talked about, you have earnings yields of below 6.5%. You're now no longer investing, in my opinion. You're speculating. So valuation does matter, and it matters a lot. Anyway, thanks for watching. Hope you enjoyed this video. Hope you enjoyed this series. If you did, ring the bell, give me a like, subscribe to our channel. I'll be doing some, single stock videos coming up here, as well as some 2-minute drills in the future for those who follow us. Thanks for watching, and really appreciate all of you. Thank you.